Every single time a stock is traded, there are these invisible forces at play. There's a hidden cost baked into every single price, and behind the scenes, a technological arms race is being fought in microseconds. It's a battle that's reshaping our financial markets at, well, literally the speed of light. So let's dive into this world, this constant tug of war between algorithms and the regulators trying to keep them in check.
So here's how we're going to break it all down. First, we'll uncover that hidden cost I just mentioned. Then, we're going to meet the high-speed algorithms that basically run the show now. After that, we'll get into the big debate about them. And finally, we'll see how regulators are scrambling to write rules for these robots.
Okay, first things first. Before we could even get to the light-speed trading and the robots, we got to nail down a really fundamental concept, this hidden cost that's part of every transaction. It's called the bid-ask spread.
So what is it? Well, at its heart, the bid-ask spread is just the gap between what buyers are willing to pay and what sellers are willing to accept. You can pretty much think of it as the market's built-in service fee for connecting a buyer and a seller.
And really, it's just classic supply and demand in action. The bid price, that's pure demand. It's the highest price anyone out there is offering to pay right this second. And the ask price, that's your supply. The lowest price anyone is willing to sell for. Simple as that.
So the math is super simple. You just take that ask price, subtract the bid price, and whatever's left, that's the spread. And for you, the person making the trade, that gap is the direct, out-of-pocket cost you pay to get into or out of a stock.
And this is why it's so important. The size of that spread tells you a ton about the health of the market. If you see a tiny or narrow spread, that's a great sign. It means there are tons of buyers and sellers, the market is liquid, and it's really competitive. But a big, wide spread? Oof, that's a red flag for low liquidity, higher risk, and it's going to cost you more to trade. All right, so now that we've got the basics down, let's see what happens when you throw some rocket fuel on it. We are now entering the world of high-frequency trading, or HFT for short, and believe me, this has completely changed the game.
And just to give you a sense of the sheer scale we're talking about, look at this number. More than half. Let me say that again. More than half of all stock trading in the US isn't done by people. It's executed by automated computer programs. They are, without a doubt, the dominant force in today's market.
So what exactly is high-frequency trading? Well, it's a method that uses incredibly powerful computers and complex algorithms to execute a massive number of orders in milliseconds or even microseconds. We're talking about speeds that are literally impossible for the human brain to even process, let alone react to. Now, this whole thing didn't just pop up overnight. It really took off after 2005, when some SEC rule changes basically blew the doors wide open for it. By 2009, HFT was at its absolute peak, making up 60% of all trading. And today? Well, now they're integrating AI and machine learning, making these algorithms smarter and faster than ever before.
And this brings us right to the heart of the matter, the great debate over HFT. Is it a good thing, or is it a source of huge, dangerous instability? Well, the truth is, it's a genuine double-edged sword.
See, on one hand, the supporters argue that all this intense HFT competition is great because it helps shrink those bid-ask spreads, which lowers trading costs for all of us. They say it provides a ton of liquidity and helps prices reflect new information almost instantly. But on the other hand, the critics point to some really serious dangers: insane short-term price swings, the risk of a system-wide meltdown, and brand new avenues for market manipulation. And that fear about volatility? It's not just a theory. The research is pretty eye-opening. A major study back in 2010 found that HFT activity directly juices up those crazy price swings by a staggering 30% on average, and up to 40% for stocks that were already jumpy to begin with. That's a massive injection of turbulence.
So what about all that liquidity HFT is supposed to provide? Well, there's a huge catch. It's often called fragile liquidity. Why? Because during a real market crisis, the exact moment you need liquidity the most, these algorithms are often programmed to just shut down. They vanish, and that can turn a bad situation into a total catastrophe.
So you've got this new world full of super-fast trading robots that can cause all sorts of chaos. What are the human regulators supposed to do about it? Well, let's take a look at the ongoing attempt to write a new rulebook for these powerful market players.
To really understand why regulators felt such an urgent need to act, you have to look at the flash crash of 2010. It all started with a single, large, automated sell order. But what happened next wasn't human panic, it was an electronic chain reaction. HFT algorithms saw the selling and piled on. amplifying it in mere minutes. Liquidity completely evaporated. $1 trillion of market value vanished into thin air. It was a terrifying glimpse into a new kind of risk, one where machines could spiral out of control faster than any human could stop them. In the wake of events like that, regulators developed a whole new toolkit. Circuit breakers are now standard. Think of them as an automatic emergency brake for the whole market. Some countries, like Italy, even tried putting a small tax on super-fast trades, basically a speeding ticket to encourage traders to slow down. Then you have rules about how long an order has to stay on the books, or strict licensing requirements for these firms.
But here's the thing. There's no single global agreement on the right way to handle this. Germany went ahead and passed its own strict HFT Act. Italy is using the tax approach. The US is a bit more indirect, putting the onus on brokers, and the European Union has its own broad framework. Everybody sees the same problem, but the solutions are all over the map.
So the big question is, do any of these different rules actually work? Well, this chart gives us a really fascinating clue. It compares market volatility in France versus Germany. Now, both are in the EU, but remember, Germany has its own, much tougher HFT law. And the data here is pretty clear. Germany's market was significantly less volatile, more stable. The big takeaway seems to be that targeted, tough regulation really can help tame some of the chaos these algorithms can create.
Which leaves us with the ultimate multi-trillion-dollar question. We're in a constant race. On one side, you have financial algorithms getting faster, smarter, and more complex every single day, especially with AI. On the other side, you have regulators trying to keep up, trying to understand and contain the risks. So who's really in the driver's seat of our financial future? The tech, or the people trying to oversee it? That is the challenge from here on out.